It's over. For years, we've sat here analyzing, debating, and connecting dots that most people refuse to see. We studied the charts, the positioning data, the open interest, and the hidden leverage. We said again and again that one day the banks would finally crack. We warned that naked short positions would grow so large they'd snap the system in half. We explained that fractional reserve paper trading against a finite physical asset was a ticking time bomb. For a long time, critics called it speculation. They called it fear-mongering. They called it conspiracy. Until today. Because today, the theory died and reality took its place. The guessing is over. The evidence is in. The system has confessed. This morning, the financial plumbing exposed what the headlines refused to say out loud. And what it revealed is nothing short of catastrophic for the banking system. While most people were staring at silver's price action, celebrating new highs, and refreshing their screens, something far more important was unfolding behind the scenes. Something darker, something structural, something that proves the global banking system is surviving on life support. This isn't opinion. This isn't interpretation. This is raw data. Earlier today, the Federal Reserve Bank of New York released its official overnight liquidity numbers. Buried inside those figures was a number that changes everything. A number so large it cannot be explained away as routine. A number that cannot be dismissed as a typo. $17 billion. In a single morning just after the Christmas holiday, major banks rushed to the Federal Reserve for emergency cash. Not millions. Not a few billion. Over $17 billion. Quietly, urgently, without fanfare. And here's what you must understand. Healthy banks do not do this. Strong banks do not tap emergency liquidity windows. Institutions with balanced books do not run to the Fed at dawn begging for cash. This facility exists for one reason only: distress. The repo window is not a growth tool. It's not an investment engine. It's the financial equivalent of an emergency room. If you're there, something has already gone terribly wrong. Banks are supposed to borrow from each other, not from the Fed. Going directly to the central bank is a public admission of weakness. So ask yourself this: why would the most powerful financial institutions on earth need $17 billion immediately after a holiday? It wasn't payroll, it wasn't expansion, it wasn't strategy, it was survival. The timing tells the story. Silver exploded higher. Short positions went underwater at record speed. Losses piled up faster than risk models could handle. And margin calls don't care about excuses. Every dollar silver rises translates into billions in losses for institutions sitting on massive short exposure. For months, those losses were hidden on balance sheets as unrealized. But markets don't operate on accounting narratives. They operate on collateral. When prices move violently against leveraged positions, the clearinghouse demands cash. Not promises, not explanations. Cash. Immediately. And when the call came in this morning, the banks didn't have enough. That's the part no one wants to say out loud. Liquidity vanished, solvency was questioned, and panic followed. So they did the only thing left. They grabbed what collateral they still had, U.S. Treasuries. And they ran straight to the Federal Reserve. They pawned the last assets they could to stay alive one more day. This $17 billion wasn't stimulus. It wasn't support. It was a tourniquet, a desperate attempt to stop the bleeding before positions were forcibly liquidated. And here's the detail you shouldn't ignore. This happened on a Friday. After Christmas, when attention is low and headlines are quiet. Bad news always hides on Fridays. Banks collapse on Fridays. Seizures happen on Fridays. And liquidity crises are buried on Fridays. They hoped no one would notice. But here at Financial Secrets, we notice everything. We watch the plumbing, not the propaganda. And what we're witnessing right now is the failure of a decades-long suppression system. For years, the playbook was simple. Sell paper silver, flood the market with contracts, push prices down, scare investors out, repeat. It worked because paper was infinite, but margin cash is not. Once liquidity dries up, the game ends, and $17 billion is proof that the barrel is empty. This marks the moment the fight changed. This is no longer banks versus investors. This is the Federal Reserve stepping directly into the trade, printing dollars to keep short positions alive. But here's the flaw. The Fed can print money. It cannot print silver. By injecting $17 billion new dollars into the system, they weaken the very currency those shorts are priced in. That makes silver stronger, not weaker. It fuels the fire they're trying to extinguish. This is a feedback loop. Bailouts push prices higher. Higher prices require bigger bailouts. And every bailout accelerates currency debasement. This is not stabilization. It's escalation. 17 billion is not the end, it's the beginning. If silver pushes higher, the next number will be bigger, and the next after that will be bigger still. We've seen this movie before. Repo stress, emergency liquidity, then full-scale intervention. Only this time, the trigger isn't housing or tech. It's a hard asset revolt. It's silver. And that should terrify anyone who understands leverage. $17 billion in margin support represents far more than most people realize. In the futures market, that amount of cash props up hundreds of billions in notional exposure. This isn't a small crack, it's a structural fracture. It's the kind of failure event that only appears right before systems reset. And notice who needed the money. This wasn't a regional lender. This wasn't a small institution. Only the largest global banks carry silver exposure big enough to cause this kind of panic. The same banks that spent years mocking silver investors are now scrambling for survival. For decades, holders of physical metal were ridiculed. They were told silver was outdated. They were told it was useless. They were told it was manipulated and therefore uninvestable. Yet today, those same institutions are pawning their best collateral just to stay solvent. This is vindication. This is proof. This is the receipt. But the crisis doesn't stop with cash. Cash only delays the real problem. Because the real problem isn't money, it's metal. Every silver futures contract represents 5,000 ounces. Banks control massive amounts of silver with very little margin. That leverage works until it doesn't. When prices rise quickly, losses compound instantly. A single dollar move wipes out tens of millions. A $5 move erases entire risk buffers. And silver didn't creep higher. It exploded. That violent move pushed banks past internal limits. Risk models failed. Value at risk thresholds were breached. Red alerts went off across trading floors. At current prices, if these positions were closed, honestly, equity would vanish. Balance sheets would collapse. That's technical insolvency. So the Fed stepped in, not because it wanted to, but because it had to. And this is where everything changes. Because once the Fed intervenes, the trade becomes asymmetric. The downside gets capped. Upside becomes exponential. If prices fall, the physical shortage remains. If prices rise, the Fed prints more. Either way, silver wins. This is why we're seeing panic behavior across related markets. Delivery demands are surging. Contracts aren't being rolled. They're being held to expiration. That signals one thing. Participants don't want cash. They want metal. Industrial buyers aren't speculating anymore. They're securing supply. Sovereign entities aren't trading paper. They're hoarding physical inventory. And the vaults are already thin. Registered inventories are near historic lows. Months of outflows drained the system quietly. Now demand is hitting all at once. When more metal is demanded than exists for delivery, the exchange faces an impossible choice. Default quietly or settle in cash publicly. Either outcome destroys confidence, and confidence is everything. If even one delivery fails, paper pricing loses credibility. Physical silver decouples instantly. Spot prices become meaningless. Paper might say 80, physical trades at 150, and availability disappears entirely. This is the point of no return. We're already seeing signs of strain in ETFs. Share counts fluctuate. Borrow availability spikes. Fees collapse. That doesn't signal relief. It signals surrender. When borrowing costs fall during a rally, it means shorts are gone. They've closed positions. They've accepted defeat. No one wants to stand in front of this move anymore. The risk is unlimited. The reward is non-existent. This creates a vacuum. No sellers, no resistance. Price moves vertically because there's nothing left to stop it. And that vacuum spreads from futures to ETFs to miners to currencies. Capital rotates fast when regimes shift. Money flees paper. Money chases scarcity. And silver sits at the center of that storm. This is where contagion enters the conversation. Because no market exists in isolation anymore. Everything is connected through leverage, swaps, and collateral chains. Silver may look small on the surface, but inside the banking system, it plays a much larger role. It is pledged, it is rehypothecated, it is used to support trades far beyond the metals market. When pressure builds here, it transmits outward. If one major institution fails to meet a margin call, the clearinghouse steps in. When the clearinghouse steps in, collateral gets seized. When collateral is seized, counterparties panic. That panic spreads instantly. Bond markets feel it. Currency markets feel it. Equity markets feel it. This is why the Fed moved so fast. They weren't protecting a trade. They were protecting the chain. A break at any point triggers a cascade. And silver was about to snap the first link. So the central bank chose intervention. They always do. They print, they dilute, they defer the pain. But every intervention carries a cost. Trust erodes. Currency weakens. Real assets reprice higher. That's why the dollar fell instead of rising. Normally, crises pushed money into dollars. This time the crisis is the dollar. Markets understood the signal immediately. Printing had resumed. Liquidity had returned. Inflation was back on the table. This wasn't announced. It was revealed. A $17 billion emergency operation is policy. It's quantitative easing without the label. It's the pivot in action. And once the pivot begins, it doesn't reverse quietly. It accelerates. Every bailout reinforces the same conclusion. The system cannot survive honest pricing. It requires suppression. It requires dilution. But suppression requires cash. And cash requires printing. This is the trap. There is no exit. That's why smart money is repositioning. They aren't debating fundamentals anymore. They're reading signals. When central banks choose inflation over collapse, the playbook is clear. Own what cannot be printed. That's why miners exploded higher. That's why physical premiums widened. That's why delivery demand surged. The market is front-running reality. Silver isn't moving because of hype. It's moving because the monetary regime shifted. This isn't a trade. It's a repricing. And repricing events don't stop at round numbers. They overshoot. They shock. They reset expectations permanently. 80 is not resistance. 100 is not a ceiling. Those numbers were built for a different world, a world where liquidity was scarce and discipline existed. That world ended quietly this morning. The $17 billion wire transfer confirmed it. No speech was necessary. No press conference was required. Action spoke louder than words. At Financial Secrets, we've said it before. Watch what they do, not what they say. And today, they printed. Printing is the final admission. It's the signal that control has been lost. Once a central bank chooses liquidity over discipline, the path is set. There's no such thing as temporary printing. There is no clean exit. There is only more. Every dollar created to save the system weakens the system it's meant to protect. That contradiction is fatal. The banks understand this. The Fed understands this. Global capital understands this. That's why behavior is changing so fast. That's why hoarding has replaced trading. That's why delivery has replaced settlement. When trust disappears, possession becomes everything. This is why silver matters. Not because it's shiny, not because it's industrial, but because it sits at the intersection of money and matter. You cannot rehypothecate atoms forever. Eventually, someone asks for delivery, and when they do, paper collapses. That moment is approaching faster than most people realize. The numbers don't lie. Inventory is thin. Demand is rising. Liquidity is artificial. Those conditions don't resolve peacefully. They resolve through price. Price is the only mechanism left to balance the equation, and price isn't negotiable. This is why volatility will increase. Smashes will be violent. Rallies will be sharper. The system will thrash as it tries to maintain the illusion of control. But illusions require belief, and belief is fading. Once confidence breaks, markets don't drift. They gape. That's why patience matters now. This isn't about timing tops or bottoms. It's about positioning for a structural shift. The greatest mistakes happen when people trade regimes like ranges. This is not a range. This is a transition from paper dominance to physical reality. Every previous example ends the same way. Gold in the 70s. Currencies in emerging markets. Energy during shortages. The pattern never changes. Only the scale does. And this time the scale is global. The dollar is the base layer of the system. When its credibility cracks, everything reprices against it. Silver is simply reacting first. Others will follow. This is why distractions will increase. Narratives will shift. Media will downplay. Confusion is a feature, not a bug. Those who wait for confirmation always pay more. Those who demand certainty miss the move. Markets reward preparation, not prediction. The $17 billion event was confirmation enough. From here, outcomes narrow. Paths converge. Either silver is suppressed indefinitely with infinite printing, or suppression fails and price explodes. Both lead to the same result: higher nominal prices. That's the paradox. That's the trap. And it's why this move isn't over. It's just getting started. What you're witnessing isn't chaos. It's rebalancing. The system is correcting decades of distortion in real time. That process is never gentle, so ignore the noise, ignore the shakeouts, ignore the headlines. Watch liquidity, watch delivery, watch central bank behavior. Those tell the truth. And the truth right now is simple. The banks blinked, the Fed printed, the market noticed, and once the market notices, it never forgets. Memory is permanent in markets. Price may fluctuate, narratives may change, but behavior leaves scars. Every trader now knows where the line is. They know how much pressure it takes before intervention appears. They know the system's breaking point is closer than advertised. That knowledge cannot be unlearned. From this moment forward, every dip will be questioned. Every smash will be doubted. Every rally will feel different. Because participants have seen behind the curtain, this is how psychology shifts. Not slowly, suddenly. Fear doesn't arrive with panic. It arrives with awareness. And awareness is spreading. You can see it in positioning data. You can see it in the options skew. You can see it in the way volatility refuses to die. Markets are no longer complacent. Complacency is what allows suppression. Alertness is what breaks it. That's why this phase is dangerous for institutions. They rely on predictability. They rely on apathy. But apathy is gone. Retail didn't start this move. Institutions did. But retail will amplify it, because once the story escapes closed rooms, it becomes uncontrollable. Silver is no longer a footnote. It's a headline risk. Risk managers now have to answer uncomfortable questions. What happens if delivery fails? What happens if spreads blow out? What happens if counterparties disappear? Those questions don't get reassuring answers. And when answers are unclear, exposure gets reduced. When exposure gets reduced, supply vanishes. This is the squeeze no one can model. Algorithms don't understand trust. They don't understand fear. They don't understand regime change. They react after the fact. By the time models adjust, price has already moved. That's why this repricing will feel irrational to those relying on old frameworks. But it's perfectly rational in a broken system. Scarcity is not negotiable. You can't print metal. You can't promise atoms into existence. You can only bid higher. And bidding wars don't end politely. They end when someone refuses to sell at any price. That's the end game. Not collapse overnight, not chaos tomorrow, but a slow, relentless recognition that paper claims are inferior to possession. Once that belief takes hold, the market never goes back. At Financial Secrets, this is the core truth we focus on. Not hype, not predictions, signals. And the signal couldn't be clearer. $17 billion didn't save the system. It exposed it. It showed how fragile leverage really is. It showed how dependent stability is on printing. That's not strength. That's a necessity. From here on, every rally tells a story. Every dip tells a story. And the story is always the same. The system is trading time for credibility, and it's running out of both. This isn't the end. It's the reveal. And once revealed, the outcome is inevitable. Inevitability is what markets fear most. Not volatility, not headlines, but paths with no exits. That's where we are now. Policy options have narrowed to a single lever. Pull it or let the system break. And that lever is printing. Every meeting from here forward is theater. The decision is already made. They will always choose liquidity. Because collapse is immediate. Inflation is delayed. And delayed pain is politically acceptable. This is why long-term charts matter more than daily candles. Zoom out, and the trend is obvious. Each crisis leaves prices higher than before. Each rescue weakens the base currency further. This isn't mismanagement. It's arithmetic. Debt cannot be repaid honestly. It must be inflated away. Silver just happens to be the metal sitting closest to that truth. It's small enough to move fast. It's essential enough to matter. And it's constrained enough to break first. That combination is dangerous. Most people won't understand this until after the move. They'll ask why it happened. They'll search for a catalyst, but the catalyst already occurred. It was the moment discipline died. From here, price discovery resumes, and real price discovery is violent. Expect pushback. Expect regulation. Expect narrative attacks. Those aren't signs of failure. They're signs of stress. When authorities fight a market, it's because they're losing control of it. You don't regulate abundance, you regulate scarcity. That's the tell. Watch what gets blamed. Watch what gets restricted. Watch what suddenly becomes dangerous to own. History rhymes loudly here. The playbook is old. Only the players change, and yet every generation believes this time is different. It never is. At Financial Secrets, this is the lens we use. Not emotion, not hope. Structure. Structure tells you where pressure builds. Pressure tells you where breaks occur. Silver is under pressure because it's doing its job. It's revealing imbalance. And systems don't like mirrors. That's why volatility will feel personal. It will shake conviction. It will test patience. That's intentional. Weak hands are the release valve. But strong hands don't react to noise. They react to signals. And the signal remains intact. Liquidity is infinite. Resources are not. That gap defines the decade ahead. This move isn't about a price target. It's about a mindset shift. From trust to verification. From promises to possession. From paper to reality. Once that shift completes, the market reorders itself. And by the time it's obvious to everyone, the opportunity phase is over. That's always how it ends. Quietly at first, then all at once. All at once is how history feels in hindsight. But in real time, it unfolds through small decisions, quiet reallocations, subtle shifts, unspoken fear. Right now, those shifts are happening under the surface. Positioning is changing before headlines do. That's always the tell. By the time mainstream voices agree, the move is mature. By the time consensus forms, risk is highest. This phase belongs to those who act early. Not aggressively, not emotionally, but deliberately. Because this isn't about chasing returns, it's about avoiding dilution. When currencies lose purchasing power, doing nothing becomes a decision. And it's usually the wrong one. This is why capital is migrating toward hard constraints. Energy, commodities, metals. These aren't trades, they're shelters. Silver sits uniquely among them, too small to absorb global demand smoothly, too critical to be ignored. That imbalance guarantees instability. Every ounce removed from the system tightens the vice. Every delay in supply magnifies the move. Mining can't respond quickly. Permits take years. CapEx takes time. You can't fix a physical shortage with policy. That's the fatal flaw in the current setup. Policymakers deal in numbers. Markets deal in reality. And reality is asserting itself again. The longer suppression continues, the worse the release becomes. That's not speculation. That's mechanics. Compressed springs don't unwind gently, so expect disbelief. Expect denial. Expect ridicule to return briefly. Those are the final defenses of a broken narrative. After that comes acceptance. After acceptance comes repricing. Not because anyone wants it, but because balance demands it. At Financial Secrets, this is the final takeaway. You don't need to predict dates. You don't need to call tops. You only need to understand direction. And the direction is clear. Liquidity will keep expanding. Confidence will keep eroding. Scarcity will keep asserting itself. Those three forces don't coexist peacefully. They resolve through price. When they do, explanations will follow. Experts will emerge. Certainty will suddenly appear. But by then, the window will have closed. This is the quiet part, the uncomfortable part, the part where conviction matters more than consensus. Because once the crowd agrees, the advantage is gone. Nothing about this process is new. Only the scale is, and scale is what makes this moment dangerous, not just for markets, for systems. So stay focused, stay grounded, stay aware. Because the next phase won't ask for permission. It will simply arrive. Arrival never announces itself politely. It interrupts, it dislocates, it forces repricing where comfort once lived. That's why the next phase will feel confusing. Signals will conflict, markets will whip, confidence will oscillate. This is deliberate. Volatility is how systems defend themselves. It exhausts participants. It shakes conviction. It forces bad decisions. But volatility doesn't change direction. It only disguises it. The underlying pressure remains constant. Liquidity keeps expanding. Scarcity keeps tightening. Those forces don't cancel each other out. They collide. And collision is where price is born. This is why narratives will multiply. Some will claim manipulation is over. Others will insist it's just a bubble. Both miss the point. This isn't about belief. It's about math. You cannot settle physical demand with digital promises forever. At some point, reconciliation occurs. That moment doesn't care about opinions. What matters now is positioning of mind, not just capital. Can you hold through noise? Can you separate signal from spectacle? Because the spectacle is coming. Markets will overreact. Pullbacks will feel like collapses. Rallies will feel unreal. That's the emotional tax of transition. Most people won't fail because they're wrong. They'll fail because they're early and impatient. Timing is brutal in regime shifts. Right ideas suffer before they win. That's why conviction must be structural, not emotional. Ask simple questions. Is liquidity tightening or loosening? Is trust rising or falling? Is supply expanding or contracting? Those answers haven't changed. Until they do, the thesis stands. This isn't optimism, it's observation. At Financial Secrets, that's the discipline we emphasize. Remove drama, remove bias, follow cause and effect. And cause and effect are aligning. The longer this drags on, the sharper the resolution becomes. Delayed reactions don't disappear, they accumulate. Pressure doesn't leak away quietly, it builds. Eventually, something gives, not because of a headline, not because of a tweet, but because balance must be restored. That restoration never feels fair, it feels sudden. Those positioned beforehand call it obvious. Those caught off guard call it impossible. Both are reactions to the same event. This is why preparation matters more than prediction. The system is telling you what it needs. More liquidity, less trust, higher prices for real things. Listen carefully, because systems speak through action, not words, and the actions couldn't be clearer. Clarity often comes too late. By the time it feels obvious, the price is already adjusted. That's the cruel efficiency of markets. Right now, we're still in the window where confusion dominates, where signals feel subtle, and where conviction feels uncomfortable. That's exactly where opportunity lives. Most people wait for peace before acting, but peace only arrives after repricing is complete. This phase rewards those who can sit with uncertainty, who can hold a view without validation, who understand that discomfort is not danger. Danger is complacency. Complacency is what allowed leverage to grow unchecked. It's what allowed paper claims to multiply beyond reality. It's what allowed confidence to replace verification. That era is ending, not with a bang, but with a slow withdrawal of trust. Trust is leaving contracts. Trust is leaving promises. Trust is leaving institutions. And when trust leaves, price takes its place. This is why moves will feel exaggerated, why reactions will feel emotional, why markets will seem irrational. They aren't. They're recalibrating. Recalibration always looks chaotic from the inside. Expect moments where everything sells off together. That's liquidity stress. Expect moments where only real assets rise. That's recognition. These swings aren't contradictions. They're stages. The final stage is acceptance. Acceptance that the old anchors no longer hold. Acceptance that stability was borrowed, not earned. Acceptance that scarcity sets the rules now. Once acceptance spreads, behavior changes permanently. Saving turns into hedging. Trading turns into holding. Speculation turns into protection. That's when trends stop being trends and become baselines. At Financial Secrets, this is the shift we track, not day-to-day noise. But behavioral change. And behavior is already adjusting. Institutions are shortening duration. Corporations are securing inputs. Individuals are questioning assumptions. Those are not reactions to price. They're reactions to risk. Risk has been redefined. It's no longer volatility, it's debasement. And debasement doesn't show up on a chart immediately. It shows up in purchasing power, in margins, in living costs. By the time it's visible to everyone, it's irreversible. That's why early signals matter. And the signals are flashing. Emergency liquidity, distorted pricing, physical demand overriding paper settlement. These are not normal conditions. They are transitional conditions. Transitions are uncomfortable by design. They force choice. They remove neutrality. Sooner or later, everyone is positioned, whether they choose to be or not. That's the reality of regime change. So understand where you are, not emotionally, structurally, because structure outlasts sentiment, and the structure right now is simple. Too much liquidity, too little trust, not enough real supply. That equation only resolves one way and one way only, through repricing that shocks those anchored to the past. That's why disbelief will linger even as prices rise. People don't abandon old frameworks easily. They rationalize, they explain, they deny it. Denial is comfortable. Repositioning is not. But comfort is expensive in transitional periods. It costs purchasing power. It costs opportunity. It costs time. Time is the one asset no central bank can print. And time is what the system is running out of. Each intervention buys weeks, not solutions. Each bailout compounds the imbalance. Each delay increases the eventual adjustment. This is the compounding effect no model captures. Because models assume confidence, and confidence is no longer stable. Once confidence fractures, behavior overrides logic. People stop optimizing. They start protecting. Protection looks conservative on the surface, but en masse, it becomes disruptive. When millions choose safety at once, markets move violently. That's the phase approaching now. Not panic selling, panic hedging, not fear of loss, fear of erosion. Those fears don't fade with reassurance. They fade only with ownership of something real. That's why physical demand doesn't reverse easily. Once someone secures supply, they don't rush to give it back. This creates a ratchet effect. Demand spikes fast. Supply returns slowly. Price must bridge the gap. No speeches, no guidance. No narratives can change that. At Financial Secrets, this is why we focus on mechanics, not emotion. Mechanics don't lie. Paper can multiply infinitely. Reality cannot. Every cycle ends when that truth reasserts itself. This one is no different, just larger. Larger leverage, larger balance sheets, larger consequences. That's why this move feels heavier, why it carries systemic weight. Silver isn't the story, it's the messenger. It's revealing stress fractures beneath the surface, fractures caused by years of distortion. When those fractures widen, assets reprice unevenly. Some lag, some leap. Silver leaps because it's constrained. Constraints define winners in inflationary regimes. Unlimited liquidity, chasing limited reality, never ends quietly. It ends with reset points, moments where assumptions break. The $17 billion intervention was one of those moments, not because of the amount, but because of the urgency. Urgency exposes fragility, and fragility changes behavior faster than data ever could. From here on, every participant is watching the same thing. Interventions, inventory, delivery, not earnings, not forecasts, not guidance. Those belong to a stable world. This is not a stable world. This is a recalibrating one. Recalibration doesn't care about fairness. It cares about balance, and balance has been ignored for too long. So expect overcorrection, expect discomfort, expect disbelief. Those are features, not bugs. They are how excess is purged. When the purge completes, a new baseline forms, higher, harder, more honest. Until then, confusion reigns. But confusion is temporary. Reality is not. And reality is asserting itself, quietly, relentlessly, and without apology. Without apology, because systems don't negotiate with emotion. They correct imbalances regardless of who's prepared. That's the final misunderstanding most people carry. They think markets care about fairness. They don't. They care about equilibrium. And equilibrium has been distorted for decades. Cheap money masked risk, leverage replaced prudence, promises replaced assets. That worked only as long as confidence held. Now confidence is thinning, not collapsing overnight, but thinning steadily. And thinning is enough. You don't need to panic about repricing. You only need doubt. Doubt changes behavior. Behavior changes flow. Flow changes price. That chain is already in motion. Every institution is now quietly stress-testing assumptions they once took for granted. Every risk desk is running scenarios they hoped would never matter. Every treasury is questioning what safe actually means. Those conversations don't make headlines, but they move markets. This is the invisible phase. The phase where capital shifts quietly. The phase where preparation happens without applause. By the time it's loud, positioning is done. That's why silence right now is more important than noise. Silence in flows. Silence in commentary. Silence before acceleration. Acceleration always feels sudden to observers, but it's never sudden to participants. Participants have been adjusting for months, sometimes years. What changes is when those adjustments hit the price, and price is beginning to respond, not linearly, not smoothly, but decisively. Sharp moves up. Violent pullbacks, false confidence, real demand. This is what transition looks like. If you're looking for comfort, you won't find it here. If you're looking for certainty, you won't find it either. What you'll find is direction. And direction is enough. At Financial Secrets, that's the point we return to again and again. You don't need to know tomorrow. You need to understand trajectory. Trajectories don't reverse without cause. And the causes that created this shift are still active. Liquidity is still expanding. Debt is still compounding. Trust is still eroding. Until one of those changes, nothing meaningful changes. That's why short-term relief rallies don't matter. That's why engineered pullbacks don't matter. They are tactics within a larger unwind, the unwind of excess confidence, the unwind of leverage, the unwind of assumptions that no longer hold. Those unwinds take time, but they don't stop halfway. They finish. And when they finish, the system looks different. Prices are higher. Volatility is normalized. Reality is respected again. That world feels harsher, but it's more stable. We're moving toward it now, not in a straight line, not without resistance, but inevitably. So measure progress correctly, not by headlines, not by daily closes, by behavior. Who is demanding delivery? Who is extending liquidity? Who is hedging quietly? Those actions tell you where we are in the cycle. And right now, those actions say one thing clearly. The adjustment has begun. The denial phase is fading. The repricing phase is warming up. What comes next won't ask for belief. It will demand adaptation. Because markets don't wait for consensus. They move first. And those who understand that aren't surprised when it happens. Adaptation is the final test. Not intelligence, not capital size, but flexibility. Systems break those who refuse to adjust. Markets reward those who see change early and move quietly. This is no longer about chasing upside. It's about surviving transition with purchasing power intact. The mistake most people make is waiting for permission. Permission never comes. By the time authority agrees, the price has already moved. By the time headlines confirm, positioning is complete. That's why the quiet thinkers always win these phases. They don't argue with the system. They observe it. And the system is speaking clearly now. Liquidity injections are becoming routine. Emergency measures are becoming policy. Extraordinary is becoming normal. That normalization is the danger. When crisis tools become standard tools, something fundamental has shifted. Stability is no longer organic. It's manufactured. Manufactured stability requires constant input. And constant input means constant dilution. This is the loop. There's no heroic ending to this story, no sudden discipline, no overnight reform. There is only gradual acceptance that value must move elsewhere. That movement is already underway. You can see it in how capital behaves. You can see it in what people stop trusting. You can see it in what they quietly accumulate. This is not fear-driven behavior. It's rational behavior in an irrational system. When the rules change, strategies must change too. Holding cash once meant safety. Now it means exposure. Holding promises once meant stability. Now it means counterparty risk. Reality is being repriced across every layer of the system. Silver is not the end of that process. It's the signal that the process has begun. More signals will follow. Different markets, different assets, same message. Scarcity matters again. For years, that idea was dismissed, mocked, ignored. Now it's unavoidable. At Financial Secrets, this is why we emphasize awareness over action. Understanding over reaction. Because once you see the structure clearly, decisions become simpler, not easier, but clearer. You stop chasing noise. You stop fearing volatility. You stop waiting for approval. You start thinking in systems, not headlines. This moment will be studied later, not for the numbers, but for the behavior. People will ask when the shift really started. It won't be a single day. It will be a series of quiet interventions no one questioned enough. $17 billion was one of them, not because it was large, but because it was necessary. Necessity reveals truth. And the truth is this: the system cannot function without constant support. That support has a cost. And that cost is paid through dilution. Once you understand that, the rest is obvious. Prices of real things must rise. Promises must be discounted. Confidence must be earned again. That process takes time, but it doesn't reverse. So, this is not the end of a move. It's the beginning of a new baseline. Higher volatility, higher prices, higher awareness. Those are the conditions ahead. You don't need to fear them. You just need to understand them. Because understanding removes panic. And panic is the most expensive mistake of all. This isn't about getting rich overnight. It's about not being silently impoverished over time. That's the real risk most people miss. So stay observant, stay patient, stay grounded in reality, because reality always wins eventually. And when it does, it doesn't ask who was ready. It only rewards those who were.